So today we're talking about capital gains and capital losses on stock transactions. Technically it's just stock transactions, but those are hugely useful tools to make decisions on what we're going to buy and sell. If you buy something and it does well, you're going to be paying what's called a capital gains tax, unless you bought something and then sold it that didn't do well and they cancel each other out, or at least reduce some of the taxes that you would pay. I pulled up a little window here, if I can get it to show. This is from Tina Orm over at NerdWallet. This is the 2019 through 20 capital gains tax rates, right? Basically, all this is, in the short term and long term, is a tax based on what you've made, profit or loss, but really profit, because you're going to get a reduction in taxes if you lose money on it. They're going to reduce how much you owe. When you look at the short-term gains are going to be at a higher rate. It's your income rate. Whereas if you go to the long term, notice we have up to $39,375. You're not going, as a single filer, sorry, gotta make sure you look at those for married filing jointly or whatever in the future, right? But you're not paying any long-term capital tax rate. Then 15% up to $434,550, and then above that 20%, right? And you can check these. This is pretty easy to find on most websites that do. Any brokerage website is going to have this information, but you can find this pretty quickly. Notice again, for married filing jointly, nothing really changed. The values changed here. You can make more. Head of household, filing separately, right? And there's a bunch of information like this on here. They even have little calculators that you can figure out what your taxes are. Now, ultimately, at the end of the day, when you're doing these and you're calculating this out, what we're really looking at is our gains based on our purchase price in the beginning and what's happened since then. So we bought something, let's say, a few years back. Let's say we bought stock for about $7,200. We're saying stock. It could be multiple shares. It could be just one share. Hopefully not one share for that much years ago. But let's say last week we decided to sell it, and we sell it for $9,200. We can quickly see the sell price and the purchase price are different. And that means we've gained plus $2,000. This $2,000 is a capital gain. It's a gross capital gain. That means there's no taxes been applied to this yet. That just means that we're going to have to record this probably in a tax form that we made $2,000 profit from this purchase. Again, how long we've held this thing is going to determine the tax rate. What our income level is going to determine the tax rate. And if we have made any other sells or be lost in capital growth, so we had a capital loss, those are going to partially, if not completely, balance each other out. It just depends on how we calculate it. So let's say 5 years ago, as another example. So 5 years ago we purchased stock for $34.87 a share. We had 300 shares. And $34.87. So we've got our calculator here, 34.87, and we said we purchased them for 300 shares of that. So we made $10,460 purchase. So we'd be down $10,461. And then we decided yesterday to sell, and we sell them for $41 even. So again, we're going to take the 41 times the same number of shares. We sold them all, and we're looking at 12,000 plus 12,300. We can subtract off the 10,461 and determine that we have $1,839 as a capital gain. Again, that's a net. This is not counting fees for purchase or sale or anything like that. These are gross values. There's no taxes that have been applied, no deductions or anything like that that's been put in. So another example, we could say we paid money through shares of a corporation. Let's say we are part of a corporation. I don't know, it could be a cell phone corporation. We're actually part of it, and we started in the beginning, and we paid $3,450 to buy shares in a company that later we sold for $6,100. So again, if we want to look at that as a difference between sell, I know I've got them backwards because I'm talking about the linear time frame of purchase and sell. Understand we are in fact subtracting these. That gives me 2,650. If we're looking at that as a profit or any kind of gain, that is our capital gain. Now, the 2,650 as part of the whole, so it's a portion of our original value, right? So when we purchased for $3,450 or $2,450. We gained $2,650. If we want to look at our growth as a rate, we'd take the $2,650. So this $2,650 is our growth over the original purchase price, which was $3,450. So if we type that in as $2,650 divided by $3,450, we're looking at a 77% increase. We'd probably stick with 76.8 growth from our original investment. Again, we've made back all of our investment. If we're referring back to the whole revenue and expenses, the profit, this is the profit for us. And we want to know, as a cost of investment, how much did we grow from it? That's a huge growth. Now, we don't know the time frame here, but 76.8% growth isn't really too bad in the stock market. Making that much is pretty good. So we'll do another example here, just one more to make sure we have this kind of locked down. If we're looking at just a general version of what we're doing to calculate this out, right, we're just going to use basic information. We know that a capital gain is simply equal to our selling price minus our purchase price. Now understand, a capital loss is going to work by and large the same way. Selling price, what do we sell for? Subtracting off purchase price. However, when we do that and we get a positive number here, then we're good to go. We get a negative number here, we know that we have a loss, capital loss, right? They're one and the same when it comes to the calculation. And then understanding how much we earned as capital gain in a percent of investment, we could simply take, let's see, we'll take the selling price minus the purchase, and we divide that by our purchase price. This right here will give you a decimal, which we then multiply by 100, and that's going to give you a gain on investment or a loss, right? Because if we take our selling price and we subtract off a purchase price that's larger and divide it by the purchase price, we're going to ultimately get a negative value, and we can look at that as a negative investment over the original purchase price. And that is really it. Our lesson's straightforward. We're just calculating capital gains or capital losses by taking, again, selling price, subtracting the purchase price, and dividing it by the purchase to get a rate, or just selling minus purchase, to find out our capital gain or loss. If it's positive, it's a gain. If it's a negative, it's a loss. And that's perfectly fine for us. We're good. If you have questions, please ask them. I'm ready to help in any way I can, but I just need those questions so that I can know where you're getting stumped, where you're struggling. If you understand it, great. Again, like I said, it's easy to find this information. You can go online to places like we just went to and find that information. It's pretty useful if you go to places like, I don't know, let's say Investopedia, for example. They've got a lot of great stuff on there, and you can use those tools, those calculators, those definitions to understand this, which is great. Being young, going forward, and having a good handle on how to make money or grow your money and be successful, that's an opportunity I wish I had when I was in school. If you have questions, email me, let me know. Otherwise, we'll see you next time.